Over the years, we have been serving the clients. Now we have 111 branches and also various off-site ATMs and cash recycling machines, plus the business banking, branchless banking proposition where we have 80 branches working on branchless banking. So all in all, about 230 customer touch points serving the clients, and along with our digital platform, the NDB NEOS, we have been serving the clients. Total staff strength is 2,700 plus. Of that, more than 40% are females, and we are the only EDGE certified workplace where we have the gender equality, which has been recognized by the EDGE, which is the economic dividend for gender equality. We are the first organization to get that EDGE certificate as well. And in terms of our digital solutions, right now almost 70% of our transactions are covered through digital channels, and we have a very strong governance framework, a very competent management team, which is reflected in our results and also the awards that we have won over last few years. So talking about the awards that we won this year so far, 32 awards won by the NDB group. The bank won about 25 of them and 7 from the group. I think the Asia Money, we have been rated as the best bank in Sri Lanka, and for also the best premium banking services, and also for the corporate and investment banking. Global Bank and Finance Review, again best SME bank in Sri Lanka, and also best bank for project financing and various other awards. And Asia Money has consecutively awarded our NDB Investment Bank, which is for the 8th consecutive year, as the best investment bank in Sri Lanka. So all in all, about 32 awards so far during the first 6 months. Moving on to the financials, this is a snapshot at very high level. We will get into the details later on. So year on year, we had a 22% growth in gross income, recording a 28.8 billion, and the net interest income that has 27% growth, relatively quite a high growth compared to the asset growth year on year, which was about 21%. Net fee and commission income, again 22% year on year growth to 1.7 billion. And pre-tax core banking profits recorded a 14% year on year growth to 4.6 billion. Total operating expenses also grew by 18% to 4.6 billion. And the profit before tax, we saw up 8% growth to cross 5 billion for the 6 months. Profit after tax, of course, that's a 15% year-on-year decline to 2.2 billion, mainly because of the high tax rates and also the introduction of the debt service levy. So as a result, the year-on-year profit after tax figure shows a negative growth. Key ratios, I would like to highlight the NIM, net interest margin, has improved from 3.34 to 3.36. Cost income ratio, 39.4% in first half last year. Now it is 40.3, so slightly declining cost income ratio, but still around 40%. ROE, last year, end of year, we recorded 17.4, I think the highest ROE among the banking industry. First half, it has come down to 10.9. Mainly, one reason is the increase in our capital level. Apart from that, as you see that the profit after tax was a decline given the high tax charges that we had to incur. ROA from 2.2 to 1.88. Now there again, ROA reduction is mainly due to, I would explain later on, mainly due to the exchange losses, more than 600 million exchange due to the appreciation of the currency. But if not, and also the asset growth, so the denominator has gone up Year-on-year asset growth was 74 billion. So naturally, the denominator also has gone up, so that is the other reason for the ROA, drop in ROA. NPLs from 2.85, that was first half last year. Actually, over a year, it has gone up to 4.5, which is a situation that we have observed across the industry, where even the industry average NPLs also have gone up to 4.8% as at June. On the balance sheet, very quickly, the balance sheet crossed 490 billion, 4% growth year to date. And then the gross loans, 19 billion growth in loans, 5% growth in gross loans, and deposits, 2% growth to 355. Moving on to the income statement. So the gross income, 22% growth, 5.2 billion growth in gross income to cross 28.8 billion. Of that, the interest income that has shown 28% growth year on year, 5.6 billion in terms of quantum. Interest expenses also 28%. So both interest income and interest expenses 28% growth, from 13 billion to 17.3. So the net interest income, which is the important figure, 27% growth year on year from 6.7 billion to 8.6 billion. Non-fund income also had a reduction year on year. This is mainly, I will explain later on, mainly due to the exchange impact. So 3.2 billion to 2.8. But if you look at the fee-based income, there is a growth, which I will explain later on. Impairment charges, again, first half we had 1.5 billion in last year. It has gone up to 1.8 billion in the 2019 first half. So all in all, the net operating income from 8.5 billion has grown to 9.6 billion, a 1 billion growth or a 13% growth. Operating expenses, it has gone up from almost 4 billion to 4.6 billion, 18% growth in the operating expenses. Then the operating profit before tax, as I mentioned earlier, 8% growth from 4.6 to 5 billion. And taxes, you would see a substantial increase in tax expenditure from 2 billion to 2.788, almost 800 million increase year on year, a 39% increase in the tax expense. So as a result, the profit after tax showed a negative growth of 15% from 2.6 billion to 2.2 billion. And then the group profit attributable to the shareholders, again, it's a drop of 2.2 billion to 1.8 billion. I think more important points here are the growth in the core banking income. That's where we have been working hard, and as a result, actually well coordinated movement in interest income. We have been managing our balance sheet quite well. The ALCO has worked very well, so that is shown in the impressive net interest income growth of 27%. Impairment, of course, there's 24% increase, which is reflected in the growth in the NPL side as well as the current economic situation. However, when you look at the industry growth in impairment numbers, where we have seen some other banks showing a quite substantial growth in impairment, our growth is 24%. I would attribute that to the strong risk management practices that we have developed since mid last year, and also the recovery process, and also the model improvements that we have been doing continuously. So over 50% of the profit before tax was paid out as tax. Actually, our effective tax rate is about 57%. More details on the non-fund based income. There again, a very good improvement in the net fee and commission income. That's where we were working hard. From 1.4 billion in the first half last year to 1.7 billion. That's 22% growth in net fee and commission income. Gains from the trading activities also showed 15% growth from 588 million to 676 million. The net gain on de-recognizing of the financial assets, it's almost same, 344 versus 353. So the total non-fund based income has gone up, has come down from 3.2 billion to 2.8. Now that's where the other operating income, that's where the exchange loss is shown. Almost 600 million is included in that. Last year we had 921 million in the operating income. Now this year it is only 100 million, mainly due to the foreign exchange loss. The first half of 2018, we had an exchange gain of 319 million, whereas first half of 2019, it was the exchange loss of 294 million. So almost 600 million, 613 million is the year-on-year gap, which is reflected in this 800 million drop in operating income. And also there's almost 150 million drop in group dividend as well, from 500 million to 350 million. So the major reasons for the fee-based income is, I would say, looking at the corporate banking and also retail, we have been growing our card base, and also in the corporate banking side on the trade-related fee-based income. So those two have contributed to increase in the business volumes coming from the fee-based income, and also the steep increase in digital-based financial solutions. As I mentioned earlier, our digital footprint is expanding, and as a result, that has contributed also to the fee-based income, the mobile app, and also the business banking, branchless banking activities that we have been carrying out. So those have helped us to get the fee-based income coming from the digital side. Moving on to operating expenses and also taxation. Overall, 18% operating expenses shown. If you go into the details, the personal expenses, the staff-related expenses, that's 13% growth. Of course, the headcount also increased. We had about 150 new staff coming in. So from 2,381 staff, actually year on year, it's almost 300 staff that have been added, from 2,381 to 2,766. Of course, these staff have been recruited. One is the branch expansion, other one is on the customer support and also the new business development side, especially on the retail and business banking side. And we see the contribution coming from the enhanced number of staff, especially on the retail and business banking segments. But despite that increase in the number of staff, the personal expenses is 13% year on year. The other expenses, that's where it has gone up 24%, from 1.6 billion to 2 billion. Of course, this has the VAT impact and also the increase in certain fixed costs. So these are the reasons for the overall increase in the operating expenses. Depreciation increase is due to large investment in the digital and also physical infrastructure that we have made over the last 1 year. Moving on to the tax breakup. So there you would see from first half 2018, 43% was the effective tax rate. Now that's where we had the substantial effective tax rate increase. Actually, it has gone up to 56%. It's mainly coming from the debt repayment levy, which was not there in the first half. Now, in the first half last year, it was not there. first half this year, we have almost 500 million paid out as debt repayment levy, which is a substantial expenditure. Apart from that, the income tax element, 1 billion last year to 1.256 billion this year. This is of course due to the increase in profit before tax. So all in all, from 2 billion tax impact last year, it has gone up to 2.788 billion. Moving on to the balance sheet, we had quite a good growth. Compared to the industry, we had growth in our balance sheet. I think first half the industry had a negative growth of almost 40 billion, the entire industry, whereas NDB had 17% growth from December last year to June this year. So our balance sheet grew by 17 billion, 4% growth in year-to-date growth. If you look at the year-on-year quantum growth, it's 74 billion. And that was the reason I explained earlier on the drop in the return on assets. So year-on-year balance sheet growth is 18%. Look at the gross loans. We had 19 billion growth for the first half this year, from 353 billion to 372 billion. That's 5% growth. Year-on-year growth was 66 billion on the loans. That's 21% year-on-year growth. Total deposits, we had a quantum growth of 7 billion. In terms of percentage, it's 2%. Year-on-year quantum growth was 57 billion. Year-on-year growth rate of 19%. I must say that the deposits, the growth rate is relatively low compared to the asset growth. But also we matched this funding by, you may recall that we went for a debenture issuance in early this year. So that is also partly supported our funding arrangements, apart from the rights issue funds that we received in the latter part of last year. So borrowings, it's from 75 billion to 87. That's again 16% growth. Year-on-year, it's about 13%. And total equity, just 1 billion growth year-on-year. That's basically the accumulated profits. So year-to-date, it's about 4%. So all in all, that's basically a highlight on the balance sheet side. So we are now the total asset is 490 billion. So we are in the threshold of the 500 billion benchmark that the regulator has set up for the time being as a systemically important bank stage. So that's where on the capital raising activities that we are working on. Moving on to the impairment analysis. Overall impairments, individual impairments that has come up from 750 million last year first half to almost 2 billion, 1.9 billion. Of course, this is reflected in the NPL ratio as well, from 2.85% last year to 4.56%. But you would also note the collective impairment, that's a release of provisions. This is mainly due to granular level provisions that we looked at, and also the model improvements that we have been doing over the years. So as a result, there was a collective provision release. And the other provision, 115 million that is shown, is on certain debentures that we hold, investment side. So overall, total provisions, there's from 1.5 billion to 1.7 billion growth. This is analysis of the loan book. You see that the pie chart shows quite a well-spread kind of exposure. There's no major concentration on any particular industry. Tourism sector is highlighted in yellow because of the recent concession industry, and also that industry after the April incidents. Our exposure is only 4%. Now, there again, out of that 4%, the Sri Lanka exposure is about 3%. Currency composition of the loan book, again, you would see that from 2018 first half to 2019, we have been working on one of our strategic goal was to move towards more rupee-based balance sheet. So the foreign currency exposure from 22%, it has come down to 20%. So the rupee-based exposure has improved from 78% to 80%. In terms of the currency composition. This is a more detailed analysis of how we have funded our book in the first half. The funding sources. So you would see the demand deposits, actually it has improved from 18.5 billion to 19.5 billion. Almost 1 billion deposits in current accounts. Savings, there is a decline from 36 billion to 32. This is mainly some of the foreign currency deposits that we had at the end of the year, which have moved out. And whereas the time deposits have grown by 20 billion, from 206 billion to 226. So overall, the deposit increase is on the LKR side, a 17 billion increase. This is mainly due to the retail banking side, where we have been very active in through our branch network, getting the deposits, and that shows the growth in the rupee-based deposit side, whereas in the foreign currency side, the growth is only 7 billion. Apart from the deposits, we also use the debenture proceeds for funding. So that's why there was not much of a pressure on gaining deposits in the first half. But moving on for the second half, naturally, we had to have our deposits growth also to match our lending growth. CASA actually is 19%, mainly due to the increase in the FD rates, and also some of the foreign currency deposits that were there in the CASA has moved out. So that's other reason that the CASA, for the drop in CASA rate, CASA interest percentage from 21% to 19%. Moving on to the capital and liquidity level, bank continue to maintain above minimum requirement. The capital tier 1 ratio stood at 9% as at June. Group level it is 10.21, the minimum requirement 7. Tier 1 also minimum requirement is 8.5, and bank is maintaining 9%. Total capital ratio minimum requirement is 12.5. A bank maintains 13.6, whereas at the group level we have 14.56. Liquidity coverage ratio is very much above the minimum requirements. So is the all currency liquidity coverage ratio, which stands at 100%, compared to minimum 100%. So bank is very well within the liquidity ratios. And capital ratios, of course, there are certain cushion, but as you move on to the next level, naturally we are working on some activities. So in the ratios, first half at June, end of year last year, the share price was 106. As of June, it has come down to 89.9, but we are seeing that picking up. I think earlier this week, it cost about 112 rupees. EPS, earnings per share, has come down mainly due to the growth in capital base as well, from 30 to 17.5. Book value of the share remains around 163. December it was 166. and that's where the price earning times 5.1 versus 3.5. So more importantly, the price to book value, I think we are one of those who is trading much below the book value, 55% of the book value. So that's again, I think with this recent price increase, these as of June, with the recent price increase, this has improved a little slightly, but still, I would say it's a good opportunity to get into NDB at these rates. So this basically covers the presentation that we have. So the forum is now open for question and answers. So I leave it up to you all to raise the question. So then once the question is ready, I will read the question, and then along with my colleagues, we will try and provide some clarity on what the questions that you may have. How to get the questions? So there are a couple of questions on, one is on the NPA. Is it still construction-related NPAs or any other areas added in second quarter 2019? So I don't think it's construction-related itself. I think it's across the sectors that the NPAs have grown up. Construction also was part of that, but it's again the other industries also had stress that we have seen. So it's not only limited to the construction sector. There is a question about, can you explain the Easter moratoriums granted by the government? Indika, would you like to take that? Because most of these customers are business banking related customers. What was the bank, along with the Ministry of Tourism, agreed that we should, provided they are registered with the Tourism Development Authority and have genuine reasons, to provide them a 1-year moratorium, and that's how we have worked on. So Indika can provide more details.
Yeah, actually, especially the SME and the market, closer to over 1 billion portfolios there, where they're eligible for the moratorium, which we are already granted. There's a requirement for the tourist board approval. So with the tourist board approval, we give a 1-year moratorium, and then after that, repayment start from 2020 June onwards. So after that, we have to look at the available cash flows at that time, and we provide a repayment plan based on their existing cash flows. So already we are over 1 billion. We have given grant of the moratorium as per the central bank and the tourist board directions.
There's one more question on non-fund and commission income. Can you explain the digital uptake in this segment? So this is, as I mentioned earlier, we have about 80 branches banking arrangement where we go to the customer for collections. Apart from that, our mobile app has been highly rated. So that's where the digital income is coming, apart from the SEFT and other transfer income. Apart from that, more importantly, on the card side and also on the trade side, as I explained, the fee-based income has improved. So these are the other two reasons. Though the volume has not grown as much, but I think we had some sizable exposures where we managed to make some fee-based income. Card side, that's a tremendous growth. We have seen portfolio doing very well, and that has helped us to get some quite a sizable fee-based income. There's a question on capital raising. Can you elaborate on the timeline to raise new capital? So we are working on a couple of fronts to raise capital. It's too early to give you a timeline, but we are mindful of the fact that we'll be reaching 500 billion asset base. So in line with that, various plans are there. So we are quite confident and we should be able to make some disclosures once certain things are materialized. So, but it won't be that far, certainly within this year. There's a question on interest expenses grew faster than interest income. Could you explain this in the context of drop in the market deposit rates? I think our interest income has increased. I think anything on that? I think it's the same, no? 28%. So I think the question, it's almost the same, 28% growth in interest income and 28% in interest expenditure. There's a question on how does the increase in staff numbers by 270 during 6 months fit with the digital strategy of NDB, and what's the long-term impact on the cost-income ratio, as the full impact of this is not reflected in the first half. Actually, this increase of 272 is year-on-year increase, June last year to June this year, and that is reflected in the cost-income, also cost-income ratio 39.4 to 40%. So slight growth in cost-income. You would have seen that the personal income personal expenditure has grown by about 12%. But I think more importantly, the increase in the staff are coming from the retail segment mainly. Most of them on contract basis, on customer interfacing activities, growing the retail base, and we had seen quite a good progress on the retail side, especially cards growth for the Dreammaker loan, the personal banking loans, or even the leasing growth. Now leasing also, we consciously set up 10 leasing centers at various locations. Sanjay, you want to brief a little bit on the retail growth side?
Yes, I think looking at expanding the leasing base, we have already done 10 leasing centers, dedicated leasing centers with our branches. Also on the personal loan side, our growth has been significant, and we have expanded our feet on street. And then on the housing loan side, also we have significantly grown this year. So we'll continue to have that momentum throughout the year.
Thanks. To answer the question, whether the growth in staff numbers would have an impact on the cost income, maybe initial few months you may see that, but the volume of growth that we have seen, for example, July, we had substantial volume coming on the retail side itself. So these volumes that have been deployed at quite a good margin would help us to cover these temporary increase in the staff, and also most of them are on contract basis. The other area that we have grown our staff is again on the support functions, especially the higher volumes naturally need some capacity arrangement in the support functions, especially on the credit approval side. So those also have helped us. But more importantly, moving on to the digital side, for example, the robotic processing that we have implemented since early this year, that's where we are trying to reduce the headcount on the support function side. So going forward, we are comfortable that we should be able to manage the cost income ratio below the 40% level. So there's a question on what is your revised asset growth projection for the year post first half, given the business climate. So as I mentioned, the June we had seen some substantial growth in our assets, especially coming from the retail sector. So we are mindful of the industry developments as well, and also the political developments coming up in the last quarter of this year. So whatever the growth that should come, naturally should come in the third quarter, because we are waiting for certain elections and all. So we need to make some judgmental call on that side. However, to our existing customers and good profitable business, we won't hesitate to take them. So, but we would have a cautious approach, keeping in mind the industry trends as well. So it's very difficult to predict because we don't want to have that accelerated growth plans that we had in the last 2 years. I think we shared this in our earlier webinars as well. We continue to share this view that this year what we did was we concentrated more on the house internal arrangement in terms of our efficiency improvements and all, and that is actually helping us. So once stability comes in, especially from next year onwards, we are comfortable that we can really propel our growth because we have done our internal work very well and we are ready for that kind of growth. There's a question on which industries are driving the higher NPLs currently. Do you anticipate NPLs ticking up further in the next quarter? My personal opinion is I don't think we anticipate any larger upticks. What would you like to share? And
I can't say that there are any specific sectors. When we spoke during the first quarter webinar, I think there was a specific sector which was mentioned, but coming forward since then, I think it is almost in the it's a wide variety of industry segments, especially in the local segment that the NPLs have picked up. But we are managing the NPLs very carefully on a customer by customer basis, of course, in relation to the overall economy that we have in hand. I'll give it to him.
On the SME side, as it is across not particular industry, I think previously mentioned the construction, tourism, those areas we have seen. But now it's across, but we are also managing individually and a separate team formed within the business line itself, mainly to monitor and follow up these very closely and give the solutions, restructuring required, all those things. So we are closely following up, I think, from the, in addition to central recovery unit within the business lines, also we form a separate team to mainly look at these projects and give solutions to these projects. So this is actually very well managed at the moment, closely following up.
There's another question on NPLs. Can you shed some light on tourism sector specific NPLs? If you were to look at the tourism exposure in isolation, so that's the question. Now there again, the overall bank's exposure to tourism sector, not the NPL, the total loan exposure is 4%. Out of that, the overseas exposure is about 1%. So the bank's exposure, local exposure to the tourism sector is about 3%. But if you look at NPLs, total NPL component, roughly between 2 to 3% is from the tourism sector. So that basically reflects well with the bank's overall asset book, and also it's not concentrated on tourism sector. Of the NPL book, it's about 2 to 3%. These are the questions I have received so far. Anything else? So I think these are the questions that we have received so far. So thank you very much for taking part in this webinar. Just got one question. Hold on. So that question is, who bears the cost of moratorium? So unfortunately, the banks have to bear the cost of moratorium. So it is a 1 year deferred arrangement, but the interest is accrued. So accrued at a lower rate, but definitely above our cost of funds rate. So that is the contribution that the bank is also giving to the industry, knowing that this is beyond the control of the customers who are involved in it. So we are also positively looking at it. So as Indik explained, our exposure in terms of the restructuring is not a significant one. Even in the NPL category also, what I mentioned was about 2 to 3% in the tourism sector. Other good news is that we have seen these clients also coming up, saying that their bookings for the second half is picking up. So we are quite confident that they should be able to manage with this moratorium offered, especially the payments are due from April next year. So at that time, so right now, I think the cost is basically managed through the interest that has been accrued. So there's a question, a good one, deposit growth. What are the levers of differentiation that NDB is following now that the rates are largely uniform across the industry? I think that's where our relationship banking is really working. We have a very good private wealth management entity, which last year we took it to the branch level, and that is paving good results, especially on the retail side. On the corporate banking side also, there are very well established corporate banking relationships. So this is where the relationship banks come in to help us. And we have been banking with these clients for many years. So that is other area that we are working closely to ensure that in a market where the rates are capped, rate is no longer the differentiator, it's going to be the service and also the relationship that we have built up. So that's where I think we are going to do well in terms of capitalizing on these long-established relationship and also personalized banking to get these deposits going up. There was a question again, can you clarify if tourism NPLs are 2 to 3% of NPL book? Yes, out of the NPL book, 2 to 3% is in tourism. It seems that those are the other questions that we have received. So thank you very much again for your participation. One thing that I want to summarize is that we have been building up the internal processes and also a very actively engaged team. And at the time that NDB is celebrating 40 years, the 40-year anniversary activity is also planned starting from next year, from next week onwards. Apart from that, we had seen quite a good momentum in terms of the group staff and also bank staff working together. Now that's where the other side that I couldn't discuss much, earlier, the group synergies that are working very well. So for example, NDB Investment Banking and NDB Bank, Corporate Banking, Project Finance teams are working very closely. So is the NDB Retail Bank and also the Wealth Management side, where we just launched the one account where a client can also make use of a current or savings account with NDB and also have the luxury of having wealth funds where that provides a higher rate. So this is a unique product that only NDB can offer because of our group presence. So is the NDB Project Finance team and in the investment banking working together, showcasing us as a premier project financing bank in the country. So a lot more are also planned in this sector. So that's again an area that we have been working hard, and that you would see more improvements coming in that sector as well. And then the internal process improvement that we are working, the robotic process automation that we have done, the BPR exercise and also the Six Sigma exercises that we have done, we have managed our processes very well. It's now lean and mean operations. So when the market picks up, we are quite geared to meet that challenge and provide more efficient customer service to our loyal customers. So we are hopeful that we should be able to show some good progress as we move on in the next couple of quarters. So with that, thank you very much for your attention, and thank you for my team as well, and also the finance team for organizing this webinar as usual. And looking forward to meeting you all in another webinar, probably the next quarter. Thank you.